Now, everyone, Mike Jones, Chairman and CEO at Caravel Concepts, joining us today. Mike, thanks so much for the time. Looked out, S&P 500, NASDAQ, all closing at all-time highs to begin the final week of 2020. What are your biggest takeaways from today's trading session?
I think this is just the market being really excited about what it's going to get to look forward to in 2021, which is another big dose of fiscal stimulus, a $900 billion bill now that the president has agreed to sign it. That's probably a down payment on what we'll see in 2021. That we think there'll be another $1 trillion infrastructure bill and could be another stimulus package as well. That means more money printed by the Fed in order to finance all this spending. The combination of fiscal stimulus and monetary stimulus is what rode markets higher in 2020. But we think in 2021, you get the added impetus of a real economic recovery. That is historically been the recipe for a bubble, and we see that prospects for 2021.
Okay, and so let's talk through, I suppose, what is the most critical thing on any type of economic policy going forward from here, and that would be the Georgia Senate runoffs. How closely are you watching these and baking that into your expectations for the markets in the future as well?
So that is a fantastic question, because obviously, if we've learned anything, it should be that polls are just about useless when you're going to set records for voter participation. And it looks like, based on the early voting data, we're going to see record participation in this Senate runoff. So polls are not going to matter. It's just going to matter how many of the rural white voters do the Republicans turn out, and how many of the urban minority and young voters do the Democrats turn out. That's all this election is going to turn on. Now, in terms of what that's going to mean for financial markets, if the Democrats take both seats, which is a tall order, that could put tax increases, particularly corporate tax increases, back on the table. That would be a headwind for financial markets that people aren't expecting. However, when you're looking at a 50-50 divide on the Senate, where the vice president would have to cast any deciding vote, that's not the kind of margin where you're going to be able to do something dramatic over opposition. And I suspect that even if there is a Democratic sweep in Georgia, not predicted, but as I said, who can predict in this environment? If that happens, we think the Senate will remain closely divided enough that any tax increases will be something the market can accept in light of all the policy stimulus that it'll be getting.
Okay, and so ultimately, I guess we'll kind of put that in the unknowns bucket. But one thing that is a known, more than likely, is that the new incoming Treasury Secretary will more than likely be confirmed. Janet Yellen, of course, who has history with economic policy, fiscal policy, and the markets know and understand where Yellen could be coming from in perspective, given the role played in rebuilding the economy from the lows of and continuing, I should say, the expansion from after the recession, the Great Recession. And so with all of this in mind, if we look towards the incoming administration, what do you make of the pairing of the Treasury Secretary, Janet Yellen, with Fed Chair Jerome Powell, who would still be in place until 2022, I believe?
Well, we've referred to the combination of Janet Yellen and Jerome Powell as a match made in market heaven. It's a dove fest, if you will. Both of these, this is going to mean that the two most powerful determinants of economic policy, the Treasury Secretary and the Fed Chairman, they're both committed to doing more to stimulate the economy, and they feel like the risk is doing too little, not too much. They both believe that there is very little inflation pressure, and that it's necessary to run what Janet Yellen has called a high-pressure economy with ultra-low unemployment if you're going to raise wages for working-class Americans. So both philosophically and from a political perspective, they both seem to be committed to pedal to the metal on stimulus. That's one of the reasons why we are so comfortable predicting that the market's going to get the 1-2 acceleration of fiscal and monetary policy. And it's one of the reasons why we believe there could be a bubble in 2021, because we don't think either of these decision makers want to take a risk if a bubble starts inflating. They don't want to take away the punch bowl. They don't want to take a risk of the kind of 2008 housing market deflation, the kind of 1990 equity market deflation that Japan saw. I don't think they'll take that risk at all. So they'll let a bubble inflate.
investors naturally could be scared off by the term bubble because it eventually signifies that it will burst. And so what should traders be mindful of?
So you bring up a great point. As I said, in this instance, bubbles pop when the printed money that has inflated the bubble is taken away. It's a deliberate decision by a central banker. And I don't think either Janet Yellen or Jerome Powell want to take away the punch bowl, want to withdraw that liquidity. I also think, if this bubble goes on longer and inflates bigger than historical bubbles, as we think will be the case, investors should not say, I'm going to sit on the sideline. Because one, that means you leave a lot of money on the table. And two, it's really hard to have that kind of discipline. So what we would suggest is that investors put specific goals out there. When the market hits here, I'm going to take out 20%. When the market hits here, I'm going to take out another bit. And just have a very disciplined de-risking strategy for as the bubble deflates, with the goal being to participate in most of the upside, but not leave all your money on the table so that when the bubble deflates, you've banked some of those excess gains.
Okay, so naturally, since we're talking about bubbles, and I can appreciate the analogy of the party, that's perhaps the only instance that we could talk about a party safely at this point in time in this environment. But with all of this in mind, bubble is a word that gets tossed around more often than not, especially thinking about the cryptocurrency environment. When you look at the dollar and you're pairing some of the correlations wherever possible with the interest in Bitcoin and where that interest has overflowed from those who have looked at the dollar or looked at other parts of the equities markets and said, I'm looking for a new opportunity for another long-term position. What do you make of where we've seen the levels rise to in the cryptocurrency space right now and in Bitcoin as a whole?
So I'm going to have to acknowledge a bias when you ask me about cryptocurrencies or, frankly, even precious metals. As an investor, I tend to prefer investing in assets that produce cash flows because I can value cash flows. And in the case of something like Bitcoin, essentially, I'm dependent upon someone to buy it from me at a higher price in order to make money. And unlike gold, I've got a 3,000-year history of gold that gives me at least some idea about what people will be willing to pay when there's a money printing frenzy the way there is right now. Bitcoin is brand new. And that makes me, as a cautious conservative investor, if I've got to defend my portfolio against a money printing frenzy from a central bank, and in this case, it's every central bank on the planet, I'd rather have equity assets. I'd rather have commodities that have been traded and valued for 3,000 years. I'll make plenty of money in those assets without having to venture into the innovative and new.
All right, Michael Jones, thanks so much for taking the time here on the day, Chairman and CEO at Caravel Concepts.